The world holds its breath. Could the U.S.-China standoff trigger a global economic storm? The echoes of a trade war threaten to collapse established markets, from oil prices to the cost of electronics, an indispensable part of everyone's life. Once an unshakable economic tandem, where American innovation met Chinese manufacturing prowess, is now cracking at the seams. In response to the U.S.'s 10% tariffs, China has retaliated with mirror duties, deepening the chasm between the two powers. Amid the escalating conflict, Donald Trump is seeking new alliances, turning his gaze to India. The recent meeting between the Prime Minister of India with Trump and Elon Musk at the White House has become a symbol of a new alliance designed to contain China's growing influence. The rapprochement between India and the United States of America could send not only China but also the entire BRICS bloc into a state of turbulence, forcing its members to decide on a future course. But what are the underlying causes of what is happening, and how will this affect the well-being of ordinary citizens, their work, and the architecture of world trade? For decades, the U.S. and China have built a powerful trading partnership, exerting a decisive influence on the rules by which world trade is conducted. In 2022, trade between the two countries reached an impressive $690 billion. At the same time, U.S. exports to China amounted to $154 billion, and imports of Chinese products to the U.S. reached $537 billion. This strengthened China's position as one of the largest suppliers of consumer goods and an important sales market for American industry. However, these thriving trade ties have undergone serious changes due to growing tensions. The first signs of the impending storm appeared in 2018, when the Trump administration, seeking to address trade imbalances and protect intellectual property, imposed large-scale tariffs on imports from China. In response, China took mirror measures, introducing its own duties on American goods, which marked the beginning of a series of mutual sanctions. By 2024, the economic battles between the two powers had revealed their tangible consequences to the world. The total volume of trade between them had shrunk to $582 billion. American exports to China fell to $143 billion, while imports from China to the U.S. amounted to $439 billion. In just 2 years, American exporters were short $10 billion, but Chinese manufacturers had it even worse. Their sales in the U.S. collapsed by $100 billion at once. It would seem that both sides suffered damage, but the scale of losses turned out to be disproportionate. In early 2025, Donald Trump, not inclined to compromise, announced a 10% increase in tariffs on all Chinese imports, thereby increasing pressure on Beijing. In response, China, wasting no time, introduced 5% duties on American coal and liquefied natural gas, as well as 10% tariffs on crude oil and agricultural machinery. This mirror action only added fuel to the already heated relations. Xi Jinping, in turn, criticized the actions of the United States, stating that China would fight to the end if the American side continued its policy of economic strangulation. This exchange of painful economic blows not only affected bilateral trade but also wreaked havoc on global supply chains, forcing companies around the world to revise their strategies in the face of increasing uncertainty. But tariff battles are only the visible part of large-scale changes. Global corporations are actively reshaping logistics routes, seeking to protect themselves from turbulence in U.S.-China relations. In this game, the beneficiaries were Southeast Asian countries such as Vietnam, Malaysia, and Singapore, which have become alternative production hubs. Vietnam showed particular agility, rapidly increasing exports to the U.S. and declaring itself as a significant player in the global trading arena. Malaysia and Singapore also did not miss the opportunity to strengthen their positions in the global economic system. By 2024, imports from Vietnam to the U.S. reached an impressive $136 billion, demonstrating an increase of 19% compared to the previous year. The trade deficit between the two countries increased to $123 billion, which is 18% more than a year earlier. At first glance, it may seem that the U.S. is strengthening trade ties with Asian states. However, an interesting nuance is hidden behind this picture. Chinese manufacturers, without publicizing their actions, are transferring production facilities to Vietnam, using its territory as a kind of backdoor to circumvent American duties and growing costs. Such a maneuver is especially noticeable in the electronics sector. Vietnam is experiencing a period of rapid export growth to the United States, demonstrating impressive performance in key sectors of the economy. Shipments of electronic equipment reached $39 billion. The machinery industry contributed $11 billion, and exports of furniture and lighting fixtures amounted to $10 billion. At first glance, Vietnam appears to be an undisputed beneficiary of the situation, but a more complex reality lies behind these figures. A significant portion of the export-oriented production capacity is still controlled by Chinese companies, adding additional nuances to the overall picture of trade relations. However, Vietnam is not the only country experiencing the effect of supply chain redirection. Malaysia is also experiencing a noticeable surge in trade with the U.S. In 2024, the total trade between the two countries reached an impressive $80 billion. Exports of American products to Malaysia jumped by 43%, reaching $28 billion, driven by growing demand for electronics, machinery, and various equipment. At the same time, U.S. imports from Malaysia increased to $53 billion, 14% higher than the previous year. Notably, despite the overall increase in trade, the U.S. trade deficit with Malaysia decreased by 75%, falling to $25 billion. This fact indicates that exports of American products to the region are growing at a faster rate than imports, which may indicate a change in the structure of trade flows and a strengthening of the U.S. position in the Malaysian market. The U.S.-China trade confrontation has forced businesses to rethink global supply chains, shifting the emphasis to an everything-but-China strategy. Companies are actively diversifying production, turning their attention to countries like Malaysia. However, this maneuver is fraught with a number of challenges. The transfer of production capacity leads to increased competition in new markets, which are significantly smaller in scale than the Chinese market. Fierce competition for market share provokes price wars initiated by Chinese companies, which negatively affects profitability and can cause political tension in the countries hosting new enterprises. The trade war goes far beyond the restructuring of logistics routes. It stimulates a full-scale technological race, especially in the strategically important area of semiconductors. The U.S. seeks to limit China's access to advanced microchips, seeing this as a key element of containment. The ban on the export of high technologies in the field of computers and semiconductors has become a powerful incentive for China to accelerate the development of its own microchip production. Despite serious obstacles related to limited access to American technologies, Chinese companies, such as SMC, are demonstrating impressive success. They have managed to establish the production of 7-nanometer chips, which indicates China's determination to achieve technological independence in critical industries. This progress underscores the country's desire for self-sufficiency and strengthening its position in the global technological hierarchy. While trade barriers are becoming a reality, China is developing its own strategies to respond to the United States, and these plans are causing serious concern. One of the main tools in Beijing's arsenal is tariffs targeting key American export goods. However, the battlefield is not limited to tariffs. China is using its dominant position in global supply chains to create additional points of pressure. A prime example is rare earth elements, indispensable minerals that are used in modern electronics, renewable energy technologies, and the defense industry. China has not completely cut off the supply of these minerals to the U.S., but has tightened control and introduced quotas, limiting access and increasing costs. This step demonstrates how China's control over key resources can become a powerful lever in trade disputes. But it's not just about minerals. China is actively restructuring its food channels. As the world's largest importer of soybeans, the country is significantly reducing its dependence on American suppliers, reorienting itself towards Brazil. Back in 2016, Brazil accounted for only 46% of China's soybean imports, but today this share has grown to 74%. In response to the trade confrontation with the United States, the People's Republic of China is taking decisive steps to diversify its sources of supply, seeking to protect itself from potential geopolitical risks. Brazil, with its vast agricultural resources and supported by government policy, has promptly seized the opportunity, strengthening its position as a leading supplier of soybeans to the Chinese market. However, what is happening goes beyond food security issues, taking on the features of a large-scale geopolitical strategy. By expanding trade ties with Latin American countries, China is increasing its influence in the region, which has traditionally been in the sphere of U.S. interests. A similar trend can be seen in the energy sector. China is actively concluding long-term agreements with key energy suppliers, seeking to reduce its dependence on the United States. An example of this is the 30-year contract with Russia for the supply of natural gas via the Power of Siberia pipeline, guaranteeing stable energy supplies. In addition, a deal has been concluded with Qatar to supply liquefied natural gas worth $60 billion, which further strengthens China's energy security. As an additional measure, China has imposed a 15% tariff on coal and liquefied natural gas imported from the United States. These energy agreements mark an important step in China's desire to reduce its dependence on the American energy market, which has recently been actively increasing exports of liquefied natural gas to China. By ensuring stable supplies from Russia and the Middle East, China is creating a kind of safety cushion in case of geopolitical instability and possible sanctions from Washington. However, perhaps the most ambitious element of China's strategy is the pursuit of technological independence. The Made in China 2025 program is a large-scale state project aimed at turning the country into a world leader in high-tech industries, in particular in the production of semiconductors. In the past, China was heavily dependent on American companies in the field of advanced microchips and other critical technologies. But after the United States imposed export restrictions against Huawei and a number of other Chinese technology giants, Beijing responded with a powerful counterattack, directing billions of dollars in investment into the development of its own chip manufacturing. The largest state-owned corporations and private investors, with the active support of the state, have launched large-scale work to develop the domestic semiconductor market, using both financial resources and opportunities for acquisitions and advanced research. If successful, this strategy could lead to China becoming one of the world leaders in semiconductor technology, seriously pushing back the dominant position of the United States. By strengthening economic ties with countries such as Brazil, Russia, Qatar, and others, China is forming a more sustainable economic system that is less dependent on the influence of the United States. The question now arises as to how the United States will react to this new reality. Will they be able to regain their position in the global economy, or will the new economic era remain under China's control? The consequences of the trade confrontation between the two countries are already being felt in various sectors of the American economy. Among those who are in the most vulnerable position are farmers, technology companies, and ordinary consumers. American farmers in agricultural states such as Iowa and Nebraska have been particularly hard hit, with a sharp increase in the number of farm bankruptcies during the period of escalating trade war. The reason lies in the fact that China was one of the largest consumers of American agricultural products, and the loss of this market led to significant financial losses for farmers. Finding new markets is a task that requires time and effort. In addition to financial difficulties, new quality standards, export restrictions, and political factors must be taken into account. Even if new markets are successfully found, full restoration of previous sales volumes may take years, if not decades. The technology world has also not escaped change. Qualcomm, a pillar of innovation in telecommunications and semiconductors, is deepening ties with China. This is not just an episode, but a tectonic shift that is breaking the usual transnational chains. In response to these challenges, the U.S. government has activated the CHIPS Act, directing billions of dollars in investment into domestic semiconductor production, seeking to reduce dependence on foreign markets and strengthen technological leadership. In a moment of renewed tension between China and the United States, Donald Trump seems to see India as a strategic ally. On February 13, 2025, a meeting was held at the White House between President Trump and Indian Prime Minister Modi. This was not just a protocol visit, but part of a large-scale strategy to strengthen U.S.-Indian ties and contain the growing influence of China. The time for negotiations was not chosen by chance. Trump announced the introduction of new retaliatory tariffs designed to punish countries that burden American goods with high taxes, affecting both China and India. Donald Trump's foreign policy strategy appears to emphasize expanding export opportunities for the American energy sector, particularly oil and gas supplies to India. According to Trump, the United States possesses vast reserves of these resources, surpassing any other country. During negotiations between Trump and Modi, a wide range of issues were discussed, from defense cooperation to trade development and technological partnership. One of the most notable events was the proposal to sell India advanced F-35 fighter jets. The implementation of this deal could significantly enhance India's military potential, providing it with additional tools to deter China in the region. In addition, the leaders of the two countries discussed the prospects for a quadrilateral dialogue involving the United States, India, Japan, and Australia, aimed at countering China's growing influence in the Indo-Pacific region. Strengthening ties with India and weakening China's position appears to be one of the key goals of American policy in the region. These actions reflect a carrot-and-stick strategy. On the one hand, Washington offers India military support, and on the other, it exerts pressure, forcing it to revise its trade policy. The world community is watching with interest how these steps will affect the balance of power in Asia. The question is how India will react to this pressure. Will it make concessions under Washington's pressure, or will it continue to adhere to a policy of balancing between the two largest economic powers in the world? A complex game is unfolding on the world stage. China is strengthening alliances with Russia, Brazil, and countries in the Middle East, while the United States, under Donald Trump, is seeking to attract India to its side. Is this not a harbinger of a deep rift between the two leading economic powers on the planet? What consequences could this have for global trade and world order? This question requires careful analysis and comprehensive discussion. Such a division could lead to serious changes in the global trading system, reshaping existing logistics chains and creating new economic blocs. Countries caught between the two poles will be forced to choose a side, which will inevitably affect their economic and political development. The impact of these processes on the global economy is hard to overestimate. A rift between China and the United States could trigger trade wars, currency fluctuations, and a slowdown in global growth. Ultimately, this will affect everyone, regardless of geographical location and political views.